Good morning, everyone. This is CA Tarun Jagdish. I hope you have all come to this RPL channel even before and attended many more classes. So, let me just give you a brief introduction about myself. I am a chartered accountant by profession, and from 2010, I am into teaching profession, and I've been taking classes for SFM and SEMPE in Kerala, Karnataka, and Tamil Nadu. All right. Even before I start my classes, the first and the most important thing that I do in all my classes is that I start with a win-win agreement. What exactly do you mean by a win-win agreement? Friends, even before I go to this agreement called as the win-win agreement, I would like to ask one simple question. Today morning, why have all of you come over here? Well, the answer is very, very simple. You are all coming over here for just one purpose. You want to get maximum marks in SFM. So let's start a little bit of chatting. Just let me know how much marks do you expect to get in your SFM examination? What are you expecting in the coming examination? Let us say you are assuming more than 60 marks at least. All right? To get this marks, alone if you do, it is not that easy. Alone if I do, it is not easy. But if you and me, we form a team and we do it together, then this is definitely possible. That agreement is what I call it as a win-win agreement. Friends, practically, there are four combinations which I would like you to know first. The four forms of agreements are, the first one, what I called it as win-win. The second one is called as win-lose. Third one is called as lose-win. And the last one is called as lose-lose. Friends, win-win means you should win, I should also win. What do you mean by win-lose? I win, you lose. Will that survive for a long term? No. The third one is lose-win. What do you mean by lose-win? I lose, you win. That also will not survive for the long term. What do you mean by lose-lose? I also lose, you also lose. That also will not work in the long term. In the long term, there is only one thing which survives, and that one thing is called as win-win, where you should win, I should also win. So friends, in this contract, so that you can get this kind of marks in the examination, we have to work as a team. I should do certain things as a faculty. You should do certain things as students. Together as a team, we will win-win. So let me put up what exactly I'm going to do so that you can get the best out of this. And I will also tell you what you should do as a student so that we can score this at least more than 60 marks. This is the basic minimum what I'm saying. And this is 100% practical because many of my past students have very clearly followed these rules and they have got these marks. That is why I would like to start with a win-win agreement. All right. Now, let us first start with the faculty. What am I going to do to make sure that you get more than 60 marks? Friends, whatever is your expectation, please pass it on the comment. I will read those comments and I will answer to you and incorporate that also over here. First, I will incorporate what I am going to do so that you have a very clear picture of what exactly we are going to do. All right. The first and the most important point is that we are here for 4 days, 5 hours per day. So this is giving me 20 hours in total. We start from 7:30 a.m. to 9:30 a.m. will be the first session. Then we will have a break. The second session will be from 11 a.m. to 2 p.m. So this will be 2 hours and the second session will be for 3 hours. So in total, we will be getting 5 hours into 4 days, that is 20 hours. In this 20 hours, what am I going to cover? And the most important thing that you need to know is that I will be doing maximum coverage in minimum time. So that in the least time possible, you can actually score maximum marks. That is point number one. Second thing, how I am going to take my class, that is also very, very important for all of you to know. So what I'm going to do is step number one, I will be focusing on the concepts, or I will be focusing on what is the logic. Why am I doing this? Many students come to me and ask me this question that, sir, I by heart this formula and I go to the examination. Here, you don't have to by heart any formulas. We will work on the logic. I will make sure that you understand the logic 100% and the logic stays in your mind. All right. This is point number one. Second thing what I will do is that only understanding logic from exam point of view is not enough. Apart from the logic, what I'm teaching you, exam point of view, we have to crack the past examination questions. Because what comes in the exam, we should get marks. That is the ultimate objective. To get more than 60 marks, whether you know logic or no, marks are important. But in my class, first we will focus on the logic. Once you get the logic, I will directly link the logic to the examination questions and we will do only past exam questions, or we will be doing probable exam questions. All right. So once you understand what is the logic, once you understand what you are trying to do, after that, if we go on cracking the past examination questions, by doing so, you will be able to get 100% clarity on the entire thing. All right. Apart from this, I will also be giving you a few of homework, which you will have to work out so that you get better practice and you become much better in your approach for the exam point of view. All right, friends, this is what I will be doing so that the next 20 hours that we have together, we can utilize maximum. All right. Now let us come to the students part. What are you supposed to do so that you can score more than 60 marks in the coming examination? Friends, from your point of view, I expect one and a very important thing that you should be doing. And this one important thing that you should do is you should work out every problem that we do in class 2 times without looking. Now, friends, this is very, very crucial. And according to me, this will, create a big change in the entire part that what you will be doing. Friends, why 2 times I will explain to you. How you will get time, that also I'll explain to you. We are spending 20 hours over here. 20 hours, I'm going to cover all the most important problems only. I am going to try covering maximum concepts in minimum time. These questions, if it's taking 20 hours over here, for you to work it out 2 times, it will not take more than 5 to 6 hours, because in class when I do it, I will do very slowly, but when you do from home, you can do it much faster. Why 2 times is because 1 time you have already done in class with me. After this, you're doing from home 2 times again. In total, you're doing every problem how many times? 3 times. If you do any problem 3 times, it goes deep down your subconscious mind, after which even if you want to forget, you cannot forget. That is the most important thing. So once you master this by just investing additional 6 hours, you don't have to solve in detail. You can scribble and solve. But once you do that, you become an expert in the concept also, in the problem solving also. And this is what is going to give you a leading advantage as far as the examination is concerned. I hope you're clear with this part, friends. Now, let me just talk about the win-win agreement. As a faculty, I will do all these points. Any other points, friends, that I need to incorporate? Please mention this in the chat zone so that I can take and consider that also. As students, I want you to do this and I want you to do homework problems. And last thing, whatever doubts you're getting, friends, please feel free to ask all the doubts. All right. You might not be comfortable asking doubts over here sometimes because in the chat box you might not be comfortable. In that case, you can directly WhatsApp me also. You can WhatsApp me on this number. Just note down this number in that case. If you have any doubts subsequently also, you can just take a photo of the question and the solution also if it is not from the workbook that I'm doing, because different books solve in different manner. You can just WhatsApp me the doubt. I will make sure that I will clarify all these doubts for you. All right. Okay. I'm now going back to this page. So now tell me, friends, if I do my part with the best way possible that I can do it, if you do your part the best way that you can do it, as a team, we will win-win and we will be able to achieve the dream marks of at least an exemption in the examination. Friends, when I'm saying more than 60, please understand that is the minimum benchmark I'm keeping. There are students who get 80, 87, 95. Many have also got an All India rank because they got maximum marks in SFM also. But the minimum basic marks, what I'm trying to say is 60, for which I will work on the logic and we will be cracking the examination questions. So friends, I hope you are clear with the win-win agreement. I would give you a minute. Can you please write down this agreement in your books? Whatever I am writing on the board, please listen to it and then I'll give you time, write down in your book so that you get 100% understanding and you do not forget anything that I'm doing over here. I'll give you a minute. Please write down this in your books now. I would give you a minute. Can you please write down this agreement in your books? Whatever I am writing. All right, friends, I hope you have written it. So now shall we start our session positively right now? Okay, let's start it positively and let me start from the basics so that there is no confusion about how you have learned and how I'm going to teach you. So please write down in your books, chapter number 1, basics. Friends, I will go concept by concept. So you have to write down the concept, then we will crack the practical questions on this concept. All right. So let me start with the most important basic concept. Concept number 1, we will start with NPV, which you must have already learned in your IPCC, in your final, but many of you do not have the practical touch to it. So we will be doing it practically now. Alright friends, let us now start with a very simple example on NPV. I will take one of the persons who have come on the chat. Let us start with Mr. Shubham. Let us assume Mr. Shubham wants to start a new business. What business does he want to start? Let us say he wants to start a new Bhel Puri business. Okay. Now please visualize a guy called Shubham. Visualize a nice Bhel Puri thela or whatever you call it next to him. Okay. Now tell me, if he wants to start a Bhel Puri business, what is the investment required for a Bhel Puri business? Let us assume he will be investing around 1 lakh. So can I say year 0, he will be investing 1 lakh rupees in Bhel Puri business? Now, let's assume he is doing this business only for 1 year. So for this 1 year, what he will be doing is he will be selling Bhel Puri, getting money, purchasing the raw material, etc. etc. Am I right? Let us assume at the end of year 1, okay, this guy has made a profit of 30,000 rupees by doing Bhel Puri business. Apart from getting this profit of 30,000 rupees, what he will do? He will sell off the entire shop, the whatever vehicle that he was, taking and running around for selling Bhel Puri. And at the end of year 1, once he sells that vehicle, 1 lakh was the initial cost. Let us assume he got back 90,000 rupees. Now tell me, what is the total inflow that he has got over here? Has he got 1 lakh 20,000 rupees back by investing 1 lakh rupees into his business? Now I have a very simple question to ask you. Is Shubham happy or is he sad? Friends, that depends on what is Shubham's expectation. If Shubham is expecting, Arey yaar, I'll put 1 lakh, I will get 10% return, I am very, very happy, then that's enough, more than sufficient. He is getting 20% over here, he will be extremely happy. Now to decide whether he is happy or whether he is sad, we have to calculate the NPV or the net present value. All right. The net present value you have already learned. The table format will be year, cash flow, discount factor, discounted cash flow. Year 0, he is investing 1 lakh. Year 1, he is getting back 1,20,000. Let us assume his expectation is turning out to be 10 percentage. That means year 0 it will be 1 and year 1 his expectation will be 0.909. So 1 lakh into 1 will give you the answer as how much? 1 lakh over here, and 1,20,000 into 0.909 will be equal to will be equal to 1,09,080. So you get an NPV of plus 9080. Now tell me friends, is the NPV positive or is the NPV negative? The NPV is positive. If NPV is positive, should we accept the project or reject the project? We should accept the project. Friends, I'll give you 2 minutes time. Can you please write down this in your books first? After which I will practically tell you a few in-depth parts of this which creates lot of confusion for the students when they go for the advanced concepts. I'll give you 5 minutes time. Can you please write this down in your books now? Any doubts you're getting? Just put it in the chat box. After which I will practically tell you in-depth parts of this which and friends, please keep on interacting in the chat box. Okay, when you're done writing, just write and reply that I'm done so that I get to know that we are going at the same pace. I will not go fast. I will go very, very slow. I want to ensure that each one of you understand. But please keep chatting with me and updating me once you're done. All right, friends, I hope you're done so far. Can someone please interact and let me know? Are you all online? Please just send a chat and let me know that you're online. Just mention your name and just say good morning or something so that I can get to know that we are at the same pace. Right, I think everyone is so busy writing that they are unable to chat. Doesn't matter, whenever you're free, just put in a message so that I will also get a flow of how things are happening. All right. Now, I'm assuming that you're done with this one thing over here. Friends, here we have to learn a few things practically. Practically, the first thing that we have to learn is that one is a cash flow that we got the answer as, let us say, 1,20,000. And the second important thing that we need to understand over here practically is what exactly is this discount factor. All right. Now, let us start with the cash flow. All right. Friends, practically, how do we derive this cash flow of 1,20,000? Practically, we will have some audited financial statements of Shubham. From this audited financial statements, we can actually derive this cash flow. How we derive this cash flow from the audited financial statements, I will now mention below. Friends, the formula that we will use for finding out cash flow will be profit after tax plus depreciation minus capital expenditure minus additional working capital. I will explain the logic of this to you now. Shubham is doing Bhelpuri business. In doing this Bhelpuri business, he will be having some cash profit. Net profit is not at all relevant as far as the financial management is concerned. We are worried only about cash profit. So what we do is, rather than just taking the profit after tax, we add back all the non-cash items, which includes depreciation and any other one. So I would say these two together will form the cash profit. Apart from this, we will have some investment. For example, Shubham has made good profit. He is investing this money into a new Bhelpuri shop. The moment he puts his money into a new Bhelpuri shop, what will happen? His investment is going up, his cash is going out. So this is what we call it as investment. And working capital is also investment. For example, if he is opening a new shop, in that case, he will require more raw material, which has to be kept there as working capital or display stock so that he can sell more Bhelpuri. So this is also a part of investment. So friends, practically, if you want to find out the free cash flow of any company, you have to use the formula profit after tax plus depreciation minus capital expenditure minus additional working capital. Can you please write down this in your books now? All right, friends. So I was telling you, we are basically having two parts. One, we are having the cash flow, and the other one, we are having the discount factor. Cash flow, I told you, is derived from the audited financials using the formula profit after tax minus depreciation minus capex minus additional working capital. Now let us go to understand practically what is the meaning of discount factor. Friends, let me ask you this simple question now. Okay. Have you ever checked a newspaper which says that, look, today's discount factor is 10%, tomorrow it will be 12%? You have seen this word discount factor only in your study material of CA final or in your IPCC FM books. You have not seen this discount factor anywhere else. Why? Why is the discount factor not available on Google? Can I Google today and say, what is my today's discount factor? Google cannot tell you that, because discount factor is actually different from person to person. Discount factor is defined with one particular word, which is investor's expectation. This is the meaning of the word discount factor. Or friends, investor's expectation can be explained in this manner. Shubham, let us say, has got 1 lakh rupees. With this 1 lakh rupees, he can actually have three options. Option number one, he can put this money in bank. If he puts his money in bank, he will get, let us say, 6%. If option 2, he can put this money in his father's business. If he is putting this money in father's business, he will be getting 10%. Instead of putting in father's business, now he is opting to put this money in Belpuri business. So now if he is putting this money in Belpuri business, how much is the return that he will expect? The answer will be bank is giving 6, father is giving 10. So he will at least expect that Belpuri business will give him 10% return. That is how the expectation comes in. Hence, discount factor is nothing but investors' expectation. Can you please write down this in your books now? This base is very crucial. Once the base is strong, I will show you how advanced problems of even bond valuation, option valuation, everything becomes easy. The base, we have to correct it first. I'm trying to go slow, friends. If by any chance you feel that I'm going fast, please chat and let me know. All right. Okay, friends. I will now recall whatever I told you. We have summarized and we have learned two things so far. First thing what I learned is cash flow, and the second thing what I explained to you is discount factor. Practically, cash flows are found from the audited financial statements where we apply the formula profit after tax plus depreciation minus capex minus additional working capital, whereas discount factor is nothing but investors' expectation. So investors' expectation can keep on changing, and as and when investors' expectation change, the discount factor will also change. I would call it as an opportunity cost also. My father is giving me 10 percentage, hence I should at least get 10 percentage from the Bhelpuri business. Can you just put this chart once again and make your base very, very strong? All right, friends. Once you are done with this one part, I will now go to the next concept, that is NPV, that we started off with. NPV is equal to present value of inflow minus present value of outflow. So here 1 lakh, or we got 1,09,080, and here we got the answer as 1 lakh. That is how we got the NPV as plus 9080. So the formula for NPV, I repeat again, is present value of inflow minus present value of outflow. All right, friends. Once we are done with this, we are done with the first concept. Now I go to concept number 2, which is the most important concept for understanding all the chapters, which I will call it as how to value any asset. According to me, this is the most important concept in the entire SFM because this is what will carry forward to other chapters also. Can you please write down this heading in your books now? All right, friends. Let us now try understanding how this concept works. All right, how to value any asset. Let me take some other person who is there in the chat box. Let me take the name of Mr. Manikam Gopinath. Okay. Is it okay, Manikam, if I call you Gopinath, I'll just call you as Gopinath. Let us assume Mr. Gopinath is planning to enter into a new business. Let us assume for time being he is planning to purchase a new auto rickshaw so that he can drive around his place, and he can make some money also out of this because he's a person who loves to grow on long drives. And let us assume Tarun is the person who is the seller of this auto rickshaw. All right. Now Gopinath comes to Tarun's office, Tarun's shop, and he will come and tell that, look, I need an auto rickshaw. What is the price of this auto rickshaw? All right. So let us assume that Tarun will say, look, if you want to buy an auto rickshaw, right now we are selling auto rickshaws for, let us say the price of the auto rickshaw is 3 lakhs, or it's turning out to be 3 lakh rupees. All right. 3 lakh rupees is the price of the auto rickshaw. Now, Mr. Gopinath will do some kind of homework on this. He will say 1 year is, let us assume the life for time being of this auto rickshaw is turning out to be 1 year. If the life is turning out to be 1 year, he will be running the auto around, and let us assume that he will be making a cash profit by running this auto of approximately, let us say 50,000. Plus, he will sell the auto rickshaw and he will be getting 2,50,000. Now tell me, what is going to be the total cash inflow that Mr. Gopinath will be getting back? He will be getting a total cash inflow of 3 lakh. Okay, now listen very carefully. Year 0, Mr. Gopinath bought this auto by paying, let us say, 3 lakh rupees. And then year 1, he is getting back 3 lakh rupees. Now tell me, is Mr. Gopinath happy or sad? Will he buy this auto if these are the numbers, yes or no? Obviously, your answer will be no, because why will Gopinath invest 3 lakh rupees today, ride that auto for 1 year, and at the end of 1 year, he will get back only how much money back? He will get back only 3 lakh rupees. That is never feasible for anybody. So Mr. Gopinath will come and tell me, look Tarun, I don't want to buy this auto because it is not feasible for me. Just like Gopinath, nobody is coming to my shop to purchase auto. Think of Tarun now. Tarun is under great tension. What will Tarun do? Now Tarun will go and tell to Gopinath, Gopinath, I will give you a special offer. The special offer which I am going to give you is that I will give you this auto having a price of 3 lakh rupees for a revised price of 2,90,000. You take the auto or you leave the auto. Now tell me friends, in this case, what will be the reply of Gopinath? Will he take the auto or will he not take the auto? Let us now think from Gopinath's point of view. They have asked him to invest 2,90,000. This money he can either put in, let us say, dad's business, where we'll assume that he will get 10%. So he will be getting how much money over there? 29,000. Or he can put this money in the auto business. Auto business, if he puts the same 2,90,000, at the end of 1 year, he will get only 3 lakhs. How much is 3 lakh minus 2,90,000? You will get the answer as how much over here? 10,000. So now tell me, which is better? Putting in dad's business where he will get 29,000 or putting in auto where he will get the value as 10,000. How I got 10,000 is 2,90,000 is the cost of the auto. 3 lakh is the selling price of the auto. He will make a net margin of how much? 10,000 over there. Am I right? So he will definitely say no to the auto and he will put the money in whose business? Dad's business. He will again come to Tarun and tell to Tarun, Mr. Tarun, sorry, even for 2,90,000, I am not okay to buy the auto. Tarun is very much worried now. He is not buying this auto even for 2,90,000. Tarun will again revise price. Gopinath, please don't leave me. I will give you another revised price. Let's make this new price as 2,80,000. Now tell me, if the price is 80,000, 2,80,000, will Gopinath buy the auto or not buy the auto? Let us check that once again now. If the price is turning out to be 2,80,000, he again has got two options. What is option number one that he is having over here? He can put this money in dad's business. Option two, he can put this money in auto. If he puts 2,80,000 in dad's business, he will get 10%. That is, he will surely get 28,000 over there. But if he puts his money in auto business, he will get 3 lakh. That is the final cash inflow minus 2,80,000, which is equal to 20,000. Now tell me, will he buy the auto? Yes or no? The answer is no. He will not buy the auto. He will put the money again in whose business? Dad's business. Gopinath will again come to Tarun and he will tell to Tarun, look, I am not willing to buy the auto. My father is giving me better money. Tarun is again freaked out. Tarun is now worried what has to be done. So now what Tarun will do is, Tarun will slowly reduce the price to 2,70,000. Now let us see, if the price is coming down to 2,70,000, what will Mr. Gopinath do? If he puts his money in dad's business, he will be getting how much returns back? He will be getting 27,000 rupees back. But if he puts his money in auto, now he will be getting 3 lakh minus 2,70,000. Do you get the answer as 30,000 over here? Bang. At this point, Gopinath will be happy. He will say, look, my dad is giving me only 27,000. You are giving me 30,000. Let me buy this auto from you. And the moment he says that, Gopinath will come to buy. But just like Gopinath is coming in, many other people will also start coming to Tarun's shop to buy this auto. And Tarun will say, sorry, this 2,70,000 looks to be very cheap. I cannot sell it at such a cheap price. Let me slightly increase the price. And what Tarun will do right now is, he will revise the price to 2,72,700. Let us now check, if the price is 2,72,700, what will be the outcome? There can be two outcomes over here. Outcome number one, which can happen over here, will be, he will put the money in dad's business. He will get 10% if he is putting in dad's business, which will turn out to be 27,270. He can put the same money in auto business. Auto business, it will be 3 lakh minus 2,72,700, which is equal to 27,000. It will be approximately 27,300. These two answers are exactly the same. So can I say 2,72,700 will become the equilibrium price at which the auto will be sold by Tarun and auto will be bought by Gopinath? Friends, right now the whole long example what we did had nothing to do with SFM as of now. It was economics, demand and supply. Now I will link this practical example of demand and supply. I will link it with SFM and I will show you how this can be applied in SFM. All right. We already learned the concept of NPV. What is the table format for NPV? Everyone please keep on talking. Here, cash flow, discount factor, discounted cash flow. Here at the end of year one, how much is the cash flow that this guy is getting? He is getting 3 lakhs. What is the discount factor? 10%. Will that turn out to be 0.909? Now tell me, what is 3 lakh into 0.909? Do you get the answer as 2,72,700? Is this exactly the same answer what I got over here by using the rule of demand and supply? So friends, now tell me, what is the moral of the story? Friends, the moral of this whole story is that the value of the auto is present value of 3 lakh rupees discounted at whatever is the expectation of the investor. This is a general rule which is applicable everywhere, friends. The most important rule of SFM, please write this down. value of an asset is nothing but the present value of the future cash flows that the asset can generate. Here, Auto was generating 3 lakh rupees. That is the reason Gopinath was willing to pay 2 lakh 72,200. Suppose tomorrow a new government rule is coming, and this rule is saying that look, there is no more Ola, no more Uber, no more public bus, no more train. Only one thing will work all across India, that will be auto rickshaw. The moment this happens, this 3 lakh of revenue will jump up to, let us say, 10 lakh. If the future cash flows is going up to 10 lakh, will I have any problem paying 8 lakh for the same auto? Today I'm paying 2 lakh because I'm getting 3 lakhs. If I get 10 lakhs, I will pay 8 lakhs. Or the most important rule over here is that the value of any asset is the present value of future cash flows that the asset can generate. I will give you 2 minutes. Can you please write down this, what is there on the board first? Then I will give you more examples on the same thing. Friends, please keep chatting. I hope you're all active over here. Just send a hi or send something so that I can assure that you're all there. Nobody is chatting, or is it that I'm not getting the chats? I'm getting a bit confused now. All right, friends, I hope you have written down till here in your books. Now you can put the most important rule over here, that value of an asset is the present value of future cash flows which the asset can generate. Please write down this in your books. This is the base. Once the base is clear, we will go to advanced concepts subsequently. Now, friends, I will tell you practically how this concept is so important. Value of an asset is the present value of future cash flows. Friends, let's take a few more examples. Earlier, there was a practical case where Facebook took over WhatsApp. How did Facebook value WhatsApp? Can you tell me? They took what are the number of users who are active on WhatsApp. Once they got the number of users active on WhatsApp, let us say there are 1 billion users. They said that if there are 1 billion users, each user, even if we charge them $1 per year, the total turnover will become $1 billion per year. This, if you multiply by 10 years, the total cash inflow will be $10 billion. Present value of that is what they worked out, and that is how the consideration was paid to WhatsApp. Now let's talk about a simple example. Let's talk about any one of your favorite actor. Who is your favorite actor? Let us say Salman Khan is your favorite actor. Now tell me, how much money does Salman Khan charge for any movie? Friends, he will charge more money only if his movies are going a hit. He will charge less money if his movies are going a flop. Or can I say, value of Salman Khan is nothing but the present value of future cash flows that Salman Khan movies can generate. Similarly, let's say for example, Himesh Reshammiya. What is the money that Himesh Reshammiya can charge for one movie? I would just say one thing, value of Himesh Reshammiya is nothing but the present value of future cash flows that Himesh Reshammiya can generate. Or friends, even if you talk about accounting standards, we have many accounting standards. For example, accounting standard for leasing. If you talk about accounting standard for leasing, in that we have something called as finance lease. How do you find out the value of finance lease? We take nothing but present value of future cash flows that the lease can generate. We have a standard called as impairment of asset. In this, we have a concept called as value in use. How do you work out the value in use? That is again nothing but present value of future cash flows. Hence, friends, this rule you by heart because I'm going to use it from today till the last day that I'm taking. That value of any asset is nothing but it is the present value of future cash flows which the asset can generate. I hope everybody is clear with concept number 2 also. All right, shall we now go to concept number 3? Concept number 3, another important concept before we go to the advanced level. In the long run, discount factor and IRR will be the same. Can you please write down this? After this, we'll go to a proper chapter, the final important concept, which is very relevant for the advanced topics. All right. All right, friends, let me now explain this part to all of you now. Friends, earlier we were taking the example of auto rickshaw. In the example of auto rickshaw, the future cash flows, what we got was how much? 3 lakh. Due to this, the price of auto due to demand and supply fell down to 2,72,800. Now suppose I want to purchase this auto. I want to work out what is my NPV. Shall I just check how will I work out my NPV now? My table format will be year, cash flow, discount factor, discounted cash flow. Year 0, I will be investing 2,72,800. Year 1, I will be getting back how much money? 3 lakhs. Am I right? Here I'll use 0.909. So this will be 2,72,800 and here also it will be plus 2,72,800. What will be my NPV now? My NPV will become 0. Can you please write down till here so that I can explain this logic to you? After that, I'll give you 2 minutes time. Please write down this in your books. All right, friends. I hope you have written down till here. Friends, now let us analyze what I told you. What is the meaning of the word IRR? IRR is the rate at which NPV becomes 0. Am I right? Here we got the NPV as how much? 0 at a discount factor of how much percentage? 10%. Friends, why I got NPV as 0 is because, listen very carefully. Originally, the price of the auto was 3 lakhs. But my expectation was how much? 10%. So if the price of the auto is 3 lakh, my NPV was becoming negative. If my NPV becomes negative, will I buy the auto? The answer is no. I will buy the auto only if my NPV is either positive or my NPV is at least 0. That is how the demand supply began. And slowly the price of the auto from 3 lakh came down to 2 lakh 90, 2 lakh 80, 2 lakh 70 when NPV became positive, and then slowly it went up to 2 lakh 72, 800. So can I say if my expectation is 10%, I will make sure that the price of the auto in the long run will move in such a way that my NPV becomes 0. Hence, I come to the conclusion that in the long run, whatever is my discount factor, will also be my IRR. So friends, this is a final important concept that you had to learn. In the long run, my discount factor, if it's 10 percentage, it will ultimately become the IRR and my NPV will become 0. All right, friends, I'll just quickly refresh the three concepts and then we will go to the next chapter now. All right. Wait, can you just write down this in your books? I'll give you a minute. Please write this down. All right, friends. Once you have written this down, I will just go and summarize the concepts that we learned. We started with the first concept, NPV, that is nothing but present value of inflow minus present value of outflow. Second thing that we learned was cash flow is equal to profit after tax plus depreciation minus capex minus additional working capital. Discount factor, I told you, is nothing but investors' expectation. After this, I told you that value of an asset is present value of the future cash flows. And the last point what I mentioned over here was, in the long run, discount factor and IRR will be the same. These are the three, four and five important concepts which you need to know even before we start getting into the chapters. This will be applicable to almost all the chapters from here onwards. All right, friends. If you have understood this, let's go to a proper chapter now. Bond valuation. Okay. Now each chapter will start looking very, very easy to all of you because we have done the basics very, very clearly. Okay. Now tell me, friends, what is the meaning of the word bond? Or when we speak about shares, we talk about, let us say, debentures, and let us say we talk about bonds. What is the main difference between these three things? This is equity holders funds. Am I right? Okay. This is debt holders funds. Bond is also debt holders funds. Now, if debenture is also debt holders funds, bond is also debt holders funds, what is ideally the difference between debentures and bonds? Friends, debentures can be issued normally by private organizations, whereas bonds are normally issued by government corporations. That is the major difference between a bond and a debenture. Can you please draw this chart in your books now? All right, friends. I hope you have written down till here in your books. Now, bonds, the major highlights of bonds is one, it will have a fixed life. There will be a fixed maturity period. Or if it is going towards perpetuity, we call it as a perpetual bond. That is point number one. The second important thing is that they make a payment on a monthly or an yearly basis, which is called as coupon payments. All right. These are the two important things. And if the bonds are being redeemed before the duration, or I'll write down over here, if it is getting redeemed before maturity, we call it as calling the bond. That is the terminology which is used over here. So can you please write down this also in your books now? Fixed life, coupon payments. If it's redeemed before maturity, we call it as calling the bond. I hope the pace is comfortable for all of you friends. In case you find that it's a little fast or a little slow, please let me know by chatting with me so that I can alter my pace so that everyone can be comfortable. I want to ensure that each and every one of you sitting here understands 100% of whatever is being taken. Okay. Now we will go to an important concept of the bond. Concept number 1, how to value a bond. Now friends, you will be able to correlate my basics with this one. Everyone interact with me. How do you value any asset? Value of any asset is nothing but the present value of future cash flows that the asset can generate. Yes or no? Now tell me, bond is also one of the assets. Am I right? Since bond is also one of the assets, can I not say that value of a bond is nothing but the present value of future cash flows that the bond can generate? Here is how we correlate the basics with the chapter. So here I'll write down now value of a bond is the present value of future cash flow which the bond will generate. All right, friends. Can you please write down this in your books now? All right, friends, just like earlier I told, value of an asset is present value of future cash flows. Value of a bond is also present value of future cash flows. All right. So if I draw a chart, bond, we have to do two things. One is we have to find out what are going to be the future cash flows. Right. And second thing, we have to find out the discount factor. Right. Now tell me friends, what will be the future cash flows as far as a bond is concerned? In bond, every year we pay some money which is called as coupon payments. This is the first thing that is relevant over here. And the second thing is they will be having something called as the redemption value. The coupon payments and the second one is called as the redemption value. All right. These are the two parts of the payments for a bond. Discount factor, as far as a bond is concerned, we call it as yield. Only the terminology is different. Yield is also nothing but discount factor only. I will explain this to you in the next concept. For time being, can you please draw this chart in your books? All right, friends, I repeat once again, value of a bond is nothing but it is a present value of future cash flow that the bond can generate. The future cash flows can be either coupon payments or it can be redemption value, and the discount factor, what we call it over here, is called as yield. Now let us go to concept number 2. Yield. What exactly is yield? Friends, this is where SFM becomes complicated for many of you. You hear too many words. You hear discount factor in one place, IRR somewhere else, yield somewhere else, KE somewhere else, KD somewhere else, WACC somewhere else. You will think, my God, there are so many things. What are these so many things? People don't understand. So very important, let me give you the overview of what exactly all these things are. Friends, we started with the basics called as discount factor. Discount factor is nothing but investors' expectation. All right. Yield is also nothing but discount factor only. But instead of using the word investor's expectation, now I will use the word bond holder's expectation. All right. When I talk about KE, which is something what you learn in the next chapter, KE is nothing but equity holders expectation. Once you learn this, there is another word called as KD. KD is nothing but debt holders expectation. Friends, all these are nothing but discount factor, but this terminology creates confusion. Last one is WACC. WACC is nothing but overall investors expectation. All right, friends, now I'll tell you, I earlier told you a concept that in the long run, whatever is the discount factor, the price will move in such a way that NPV becomes zero, hence it becomes IRR. All these things being discount factor, in the long run, price will move in a way that NPV becomes zero. Hence, all these are nothing but the IRR in the long term. Can you please write down this in your books now? Friends, please do give me the feedback on the speed at which I'm taking. Is it slow? Is it fast? Is it moderate? Because if I become fast, many of you won't understand. If I become too slow, you might become bored. The pace has to be accurate. All right. So please do give me your feedback either by way of WhatsApp or by YouTube chat and let me know how we are going and if I need to increase the pace or reduce the pace. All right, friends. Now, if you have written down this, yield is nothing but bondholders' expectation. Now, I will write down concept number 3. There are basically 5 types of yield. And by the time you learn these 5 types of yield, we will actually be done with 70% of the chapter. The 5 types of yield are, first one is called as current yield. Second one is called as bond equivalent yield. Third one is called as effective annual return. Fourth one is called as yield to maturity. Inside this we are having 2 headings. One is YTM without considering time value of money. And the second one is YTM after considering time value of money. Can you please draw this chart? Then I'll show you each one of these concepts separately, one by one. After we learn these 5 types of yield, we will be doing one examination question which covers 4 permutation combinations of bond valuation. A very good question. All right, friends. I hope you have drawn this chart in your books. Shall we do it one by one now? All right, let's do it one by one. I'll write down subconcept number one, current yield. I will give you the formula over here first, and then I will tell you what is the logic of this formula. All right. Current yield, the formula as per your books is coupon amount divided by current market price. All right. Friends, let us take some simple number to understand this properly. Let us assume the coupon amount is 10 rupees. That is a face value of 100 rupees into 10 percentage coupon rate divided by, let us assume the current market price of the bond is turning out to be 90. So if I do this, I will get the answer as 10 divided by 90, which is equal to 11.11 percentage. Friends, I'll give you a minute. Write this down. Think what can be the logic of this formula. After which I will give you the whole logic in writing so that once you get the logic, you never forget and you do it properly in the future also. Can you please write down till here in your books now? Alright, I will now explain the whole logic to you. Everybody interact with me. How much money has he invested over here? I'll just put it over here. Amount invested is how much over here? Is it 90 rupees? So as an investor, we are always thinking from investor's point of view because he is the one who's putting the money. All right. So let's think from investor's point of view. And now tell me, he is investing 90 rupees. How much money is he getting back over there? He is getting back 10 rupees over there. Am I right? So can I say he is getting 11.11% return on his investment? Now let us assume me as an investor, if I put in my father's business, suppose my father is giving me 13 percentage. In that case, will I purchase this bond? The answer is no. I will buy this bond only if my father is giving me either less than 11.11 percentage or is giving me exactly equal to 11.11 percentage. Am I right? So can I say 11.11 percentage is the return that I'm expecting from my business also? That is the reason I'm putting my money over here. So if 11.11% is the return which I expect, it becomes my expectation. So if I want to write down, I will put the logic like this. Okay. If I invest 90 rupees, I get 10 rupees in hand, which is 11.11 percentage. If my father would give me 13%, I wouldn't buy the bond. I am buying the bond because my father gives me less than or equal to 11.11 percentage. Hence, this becomes my expectation, all right, which is yield, current yield. Friends, can you please write down this in your books now neatly? Give me a minute, I'll just refill my water and I'll get back in a minute. Please write down this up to then, okay? All right, friends. I hope you have all written down till here in your books. So let me just go back. Or are you still writing? I believe you are still writing. All right, friends. So let me now repeat once again. We basically had five types of yield: current yield, bond equivalent yield, effective annual return, yield to maturity without considering time value of money, and after considering time value of money. In that, we started with the first one, current yield, and the formula for current yield is coupon amount divided by current market price, or the logic is if I invest 90 rupees, I am getting 10 rupees, my return is 11.11 percentage. If my father was giving me 13 percentage, I will not buy this bond. I am buying this bond only because my father is giving me less than or equal to 11.11 percentage. Hence, this becomes my expectation. I hope you are clear with this part, friends. Okay, in that case, let me now go to the next sub-concept. Write down the next heading. Sub-concept number 2, bond equivalent yield. All right. As I did for current yield, I will now give you the formula for bond equivalent yield. Friends, bond equivalent yield is equal to discount amount divided by current market price. Let's put some number. Let us say, I'll give a heading called example. Let us say a face value of a bond is 100. They're issuing this bond at a discount of 5 rupees. Hence, the issue price, which is the current market price, turns out to be, let us say, 95. So here the formula would be 5 divided by 95, which is equal to 1 minute, friends. Let's check the rank. 5 divided by 95 will give you 5.26 percentage. Sorry, my calculator suddenly crashed. I'll get a new one. Okay, this is the answer that you get over here. All right. So write down this, think what is the logic, then I will tell you what is the logic of this, just like we did earlier. Okay. All right. I will now explain the logic to you, friends. The logic goes like this. Friends, earlier we learned the concept called as current yield. Now we are learning a concept called as bond equivalent yield. Exam point of view or practically also, current yield is used in cases where, in case of, I'll call it as normal bonds. Okay. Whereas bond equivalent yield is used in case of zero coupon bond. Everyone tell me, what do you exactly mean by a zero coupon bond? These are the bonds in which there are no coupons at all. These bonds, what they do is, they will issue at a discount. Or what they do, they issue at a discount. After issuing at a discount, they will redeem either at par or they will redeem at a premium. So I make my money by purchasing at a lower price and selling at a higher price, but there is no coupon involved over here. So bond equivalent yield is used in cases where there is no coupon and there is only a discounted case. So let us understand this. In this example, the face value is 100, discount is 5, and the issue price turns out to be how much? 95. So as an investor, I am investing how much money in the bond? 95. At the end of 1 year, I am getting back how much rupees in my hands? I am getting 5 rupees in my hands. Am I right? So as an investor, I am getting 5 by 95, that is 5.26 percentage. This turns out to be my ROI. Now tell me, if my father was giving me 7 percentage, will I buy this bond? No, I will put my money in whose business? In father's business. Why am I putting this money in this business is only because my father is giving me either less than or equal to 5.26 percentage. Hence, this becomes my expectation. So friends, in your book, you give a heading called as logic and you write down like this. I buy a zero coupon bond. I invest 95. I get a return of 5. Hence, my ROI is 5.26%. If my father gave 7%, I won't buy this bond. I am buying this bond only because father gives less than or equal to 5.26 percentage. Hence, this becomes my expectation. Can you please write down this in your books now? Alright friends, I hope you have written down till here in your books. Shall we now go to the next concept? So friends, let's revise. We learned point number 1, current yield. Then we learned bond equivalent yield. In bond equivalent yield, I would like to give you one more example to make it all comprehensive. The second example will go like this. Face value is, let us say, 100 rupees. Let us assume that the discount is turning out to be 3%. Alright. So what will be the issue price over here? Can you tell me? It will turn out to be 97. And let us assume now the duration is not 1 year. The duration is 6 months. This is a second scenario which I would like to explain to you. So friends, in this case, I will use the formula bond equivalent yield is equal to discount amount divided by current market price. What is the answer that I get over here? Let's check it together now. 3 divided by 97. I'll get the answer as 3.09 percentage. Friends, 3.09 percentage is for 6 months. So yearly bond equivalent yield will turn out to be 3.09 into 12 divided by 6. So my answer will turn out to be 6.18 percentage. Can you please write down this example also in your books now? 3.09 into 12 divided by 3.09 into 12 divided. Alright friends, I hope you have written down till here in your books now. Okay, so we have done with bond equivalent yield. Now I'll write down subconcept number 3. Effective annual return. Effective annual return. Alright. Friends, I will now explain to you. Earlier I drew a chart showing current yield is done in case of what? It is done in case of normal bonds. Okay. Whereas in case of zero coupon bond, we can use either bond equivalent yield, or we can use effective annual return, or we can use effective annual return. All right. Can you please draw this chart in your books now? All right, friends. Now I'll tell you how effective annual return is different from bond equivalent yield. Let us take the earlier example that I gave you over here. Let's talk about this example. In this example, the answer what we got over here was 6.18 percentage. Am I right? But when you speak about effective annual return, the initial formula is okay. There is no problems over here. But they don't believe in getting this answer as 6 by 18. They say this answer is incorrect. Why they say it's incorrect is because I am just multiplying it directly by what? 12 by 6. By doing 12 by 6, I am actually using simple compounding. What effective annual return says is that you should not use simple compounding. You should go for a proper compounding. Or let me do it numerically and show you. Okay, I'll take the same numbers here. Just a minute, friends. Okay. The same numbers I'll start using over here now. We had a face value of 100. We had a discount of 3. So what was the issue price that I got over here? It was 97. So step number 1, even to find out effective annual return, is to find out the bond equivalent yield. All right. So that will be nothing but 3 by 97. I believe we got the answer as 3.09 percentage. After getting this answer, only then in step number 2 can I find out the effective annual return. So what I will do over here is I'll first show you the formula. The formula will be 1 plus 3.09 percentage whole raised to 12 by 6. Okay. So by doing whole raised to 12 by 6 minus 1, or formula terms it will be 1 plus y whole power n minus 1. Let's do this and see what is the answer that we get over here. 1.0309. I'll get the answer as 6.27 percentage. First you write down this, then I will tell you the logic for this one also. All right. Let me now explain the logic of this to you, friends. Friends, if we speak about bond equivalent yield, we just directly did 3.09 into 2. All right. We got 6.18. Is that the answer what we got? Yes. But when we did effective annual return, we were doing a proper compounding. All right. Doing a proper compounding means we got the answer by doing proper compounding as 6.27 percentage. I will show you with a chart how proper compounding is done. Okay. Let us say the price is 97. Okay. 6 months, 6 months. So here it will be 97 plus 3.09 percentage. Can you just take your calculator and do it? you will get the answer as 100 over here. All right. Here I will do 100 plus 3.09 percentage. All right. That will give me the answer as what? 103.09. So can I say 97 has actually increased to 103.07? So the overall increase that is happening over here is 6.09 on a base of 97. So just take your calculator and check. 6.09 divided by 97, you will get the same answer of 6.27 percentage. This is exactly what they are doing. Can you please draw this chart in your books now? Alright friends, I hope you have put up till here in your books. So friends, we are done with three parts now. We are done with current yield. We are done with bond equivalent yield. We are also done with effective annual return. Am I right? Shall we now go to the fourth one now? I'll write down subconcept number 4. Yield to maturity. Okay. Friends, yield to maturity, I told you we are having two parts. One is yield to maturity without considering time value of money. And the other one is yield to maturity after considering time value of money. Am I right? Friends, in my language, I would say, listen carefully once again. Earlier, when I took the basic concept, I told you discount factor is investors' expectation. In the long run, investors' expectation or discount factor will adjust the price in such a way that your NPV will become zero. Hence, in the long run, your discount factor and your IRR will remain the same. This is what we learned, right? Now, I told you discount factor is investors' expectation. Just like that, yield is also bondholders' expectation. Or I also told you in the long run, whatever be the yield, the price of bond will move in such a way that the NPV will become zero. Or can I say, I'll just write down over here, in the long run, yield and IRR will be the same. All right. This yield to maturity formula will give you the correct IRR. If you're not considering time value of money, you will get an approximate IRR. But if you are using after considering time value of money, you will get accurate IRR. Can you please draw this chart in your books now? All right, fine friends, I'll just show you how we do it first. So I'll start with Roman number 1, yield to maturity without considering time value of money. I'll first give you the formula. I will give you a few numbers, after which we will discuss it together, and I'll give you the whole logic in writing so that you have no doubt whatsoever afterwards. All right. Now, everyone look over here. Let me just write down this over here. Let us assume the face value is 100. Let us assume the issue price is turning out to be 90. Let us assume the redemption value is turning out to be 110. Let us assume the life is turning out to be 5 years. and let us assume the coupon rate is turning out to be 10%. Okay. YTM, the formula goes like this: discount amount plus redemption value minus issue price divided by life whole divided by redemption value plus issue price divided by 2. Or in our case, the face value is 100, issue price is 90. So there is a discount of how much happening over there? 10. Plus the redemption value is how much? 110. Issue price is how much? 90. Divided by life is how many years? 5 years. Whole divided by 110 plus 90 divided by 2. Or the answer would be 20. That would give me 10 plus 20 by 5 is 4. 14. It will be 14 divided by 100. I will get the answer as 14%. Friends, I'll now give you 5 minutes time. Peacefully write down this formula. Think what is the logic. After that, I will explain the whole logic to you and I will give you the whole logic in writing. Your 5 minutes starts now. All right, friends, I hope you have written down till here. I hope you have thought what is the logic of this. Now I will tell you the logic of this first, then I will give you the whole thing in writing. All right, let's start with the logic. Okay, friends, I told you I'm thinking from whose point of view? Investor's point of view always. All right. So when we are talking purely from investor's point of view, we have to look at two things. Okay. Point number one, what is the returns that I'm getting? Point number two, how much is the investment that I'm making over here? Okay. Let's start with the investment. As an investor, today, how much money am I putting in the company? 90. All right. But there is some appreciation and some gain because of which towards the end, how much money am I getting back? I am getting back 110. So can I not say 110 is nothing but my investment plus my profits which has got reinvested? So opening investment is 90. Closing investment is 110. Am I right? So what is my average investment that is coming over here? 100. 100 is what I call it as average investment because my profits which I should have got immediately, I did not get. That is why it has got reinvested. That is why I am getting 110 on expiry. Everybody clear so far? So one thing I got, my investment is 100. Now let us look at my return. Here I am having two types of return. One, the bond is issued at a discount. I get a return of 10 rupee. Sorry, not at a discount. Sorry friends. Coupon. My coupon rate is turning out to be, friends, I'm sorry, I made a mistake over here. This is supposed to be coupon amount. Sorry friends, just correct that part. It is coupon amount, all right? Okay. Now, please interact with me, friends. What is the coupon amount that I'm getting over here? It is turning out to be 10 rupee. So can I say I will get 10 rupee in year 1, 10 rupee in year 2, 10 rupee in year 3, 10 rupee in year 4, 10 rupee in year 5, or this 10 rupee I will be getting every year. Am I right? Now, apart from this, I am also having a gain. The gain what I am having is I am selling my bond at 110. I bought this bond for 90. What is the gain I'm making over here? 20. This 20 is the gain for the entire 5 years. So what is my average gain per year divided by 5? Do I get the answer as 4 coming over here now? So 10 is my coupon, 4 is my gain over here. What is the total return that I'm getting over here now? Can you tell me? I get the answer as 14. So friends, if you look at me, I am getting a return, average return per year of 14 rupees, and my average investment is turning out to be 100 rupees. Hence, my ROI over here turns out to be how much percentage? 14 percentage. If my father was giving me 15 percentage, will I buy this bond? The answer is no. I am buying this bond today only because my father is giving me less than or equal to 14 percentage. Hence, this becomes my expectation. Can you please scribble down this whole chart in your books? Then I will again give you the whole logic in writing. Sorry friends, a small mistake happened. I should have used the word coupon. By mistake, I used the word discount. Please correct that and make it coupon amount. Okay. Friends, the morning session up to 9:30 will be all concepts. Then you will have a break. 11 o'clock, we will start cracking problems so that you get the whole picture very, very clear. We'll be doing two very good questions on bond valuation. These two questions will cover almost 90% of the concept of this chapter of bond valuation. So one day before the exam, whatever questions you must do, those questions we will be doing over here. All right, friends, I will now give you the whole thing once again in writing. Okay. I'll write down. I am thinking from investor's point of view. All right. As an investor, I would focus on two things. Okay. I'll write down investment and returns. Okay. Then I'll write down Roman number 1, investment. Okay. Inside that I'll write down initially I invested 90 rupees. My closing investment value becomes 110 rupees. This means my profits have got reinvested. Okay. Therefore, my average investment for 5 years is 100 rupees. Please write down till here first, friends, then I will go to the next page and I'll dictate the remaining part. Alright friends, I hope you have written down till here in your books now. I'll go to the next page now. Okay. Woman number 2. Returns. Okay. I am getting 2 types of returns. Coupon and capital gains. Okay. I'll write down. First one is what? Coupon. I get 10 rupee every year. Okay. Capital gain. I get 20 rupees in a span of 5 years. Hence, average per year is how much? 20 by 5 is equal to 4 rupees. Therefore, total average return per year is 14 rupees. Can you please write down till here in your books now? Alright friends, if you have written down till here, then I will write down my ROI will be average return, which is 14, divided by average investment, which is 100, which will give me 14%. Okay. If my father gave me 15%, I wouldn't buy the bond. Okay. I am buying the bond because father gives me less than or equal to 14%. Hence, this is my expectation. Can you please write down till here in your books now? Alright friends, have you all put up till here in your books now? Okay, if you have put up till here in your books, now let's do one thing. Okay, we have learned what is yield to maturity without considering time value of money. The final concept for the morning session, yield to maturity after considering time value of money. Friends, I told you this is nothing but the accurate IRR. Okay. So Accurate IRR is nothing but the rate at which NPV becomes 0. So we will do interpolation now. All right. I'll show you how we will do it. You first listen. I will then give you time to write down. Okay. Here, cash flow, discount factor, discounted cash flow. Year 0, the investment is 90. Year 1 to 5, 10 rupees what I am getting. At the end of year 5, I am getting a redemption value of how much? 110. Am I right? Now the discount factor, we got the approximate IRR over here as 14%. So I will start with 14%. So here I will write down the answer as 1. And for year 1 to year 5, we will be doing it in this manner. Just a minute, friends. I'll get the annuity factor as 3.43. Friends, there's a shortcut using which I got this 3.43. I did 1 divided by 1.14, pressed equal to 5 times in my calculator. Then I pressed a button called GT. I hope you have that button in your calculator, or you should do 1 divided by 1.14 equal to memory plus, like that. You have to do it 5 times and plus memory recall. You will directly get the annuity factor. All right. And at the end of year 5, it will be 0.519. Okay. So the discounted cash flow will be minus 90, 34.3, 110 into 0.519, which is 57.09. All right. So I'll get the number as 57.09 plus 34.3 minus 90. My NPV will be plus 1.39. Okay. Now for getting NPV as 0, I will have to use a higher discount factor. So I will put discount factor at, let us say, 15%. Friends, the gap should always, I repeat, the gap should always be only 1%. You should never take a gap of 2%. Your answer will not be accurate then. I will write 1 over here. Now year 1 to 5, it will be 1 divided by 1.15. I'm pressing equal to 5 times. Okay. And then I'm doing GT. I get the number as 3.35, and I will take the discounted cash flow. Minus 90, 33.50, 110 into 0.497 will be 54.67. And now my NPV will be 33.5 plus 54.67 minus 90. That will be minus 1.83. Everybody is clear so far? Okay. Once you get this answer, we have got plus NPV in one place, and then we have got minus NPV in the second case. Now we will do interpolation. How we will do interpolation will be like this. Okay. Now, all right. As of now, initially it was 14%. Then I took 15%. For 14%, my NPV was plus 1.39. And for 15%, it is minus 1.83. I want to get the NPV as 0. So from here to here, the traveling is only 1.39. But from here till here, I will be getting 1.39 minus 1.83. That will be plus 1.83. I will get the number as 3.22. All right. So I want to get what should be the discount factor over here. I will put the formula 14% plus 1.39 divided by 3.22. Okay, so I'll get the answer as 14.43%. This is the accurate IRR, or the rate at which NPV becomes 0. And this is the concept of yield to maturity without considering time value of money. I'll now give you 5 minutes time, friends. Can you first write down this in your books? After which I will switch the page and then you can write down the next one also. Your 5 minutes starts now. All right, friends, I hope you have written down till here. Can I go to the next page now? All right, please draw this chart in your books. Draw a bit neatly. I'm not very good in drawing. So I think there's some issue with the chat box as such. I'll check that and get back to you because I'm not getting any of your chats. Okay, I'm getting the chats now. Sorry friends, I think there was some issue in the chat box because of which I was unable to read any of your messages. Being the first session, there is a little confusion. Next one, we can do it. And yes, I just check a feedback that I can align my screen a little bit to the left because little bit is getting missed out. I will correct that also in the coming part. All right. All right. Okay, fine. So friends, I'm sorry I've missed out a lot of chats, whatever has happened. Okay, we will definitely, next thing, I will be making sure that the chat is also coming live and correctly. There was some issue with my chat box. Fine, friends, if you're done with this, I'll just give you a quick summary of whatever we were discussing so far. We learned 5 types of yield. Now, exam point of view, which yield when to use is a question. Let me put all the yields first. First, we learned current yield. Okay. Then we learned bond equivalent yield. Then we learned effective annual return. After that, we learned yield to maturity. Inside which we got yield to maturity without considering time value of money, or we got yield to maturity after considering time value of money. Friends, in the exam, when a question comes, details what are given, based on that you have to check the formula. For example, if the details is only given about coupon rate and the current market price, you have no choice but to go by current yield. All right, current yield will give you the yield today. Today's coupon is this much, today's market price is this much, hence this is the return that I am getting. If the question provides details of zero coupon bond, all right, we normally use bond equivalent yield. What is discount amount divided by current market price? Everybody is clear so far? Sometimes the question will very specifically ask you, this is only in specific cases, find out the effective annual return. That is when you have to do 1 plus y whole power n minus 1. Okay, but this y over here is nothing but bond equivalent yield. Everybody clear so far? So this, sometimes the problem will be, friends, they will give 81 days, etc. So raised to 365 by 81, etc. not practical for us to find out using calculator. So you can ignore it. You can go by bond equivalent yield. If they provide all the data, like they provide the issue price, they give the redemption value, and they give all these things, in that case, we should go and we should find out yield to maturity. All these 5 things are nothing but yield. Yield is nothing but bondholders' expectation. Yield is nothing but bondholders' expectation. And yield to maturity, according to me, is the best formula among the rest. Okay. Even inside yield to maturity, the accurate IRR is the best formula. But exam point of view, you have to focus on the yield to maturity without considering time value of money. Normally, we don't do the IRR method in the exam. So let me just highlight and show you, out of these formulas, give importance to current yield if these details are given, bond equivalent yield if these details are given, and this is the formula which we use from the exam point of view, unless they specifically mention for you to find out the IRR. Otherwise, we normally do not do IRR. We go by YTM without time value of money. All right. Okay. Now the next question, what they have asked is one doubt which has come in the chat box. Is effective annual return and annualized yield the same? No, my dear friend. Annualized yield is something what you will learn in the chapter called as mutual funds. That is not relevant over here. Annualized yield is a return for the mutual fund which is for the whole year. that is somewhat similar to bond equivalent yield. We will do it when we do mutual funds. All right. Can you please draw this chart also in your books, friends? Okay, Ruchi, you have a doubt that all throughout bond valuation, we have to consider it from the investor's point of view. Yes, the whole chapter of bond valuation and whatever we are doing in the entire SFM, we are doing from investor's point of view only, because only when the investor puts money, then only they're looking for return. And SFM is all about investor putting money and taking a return out of that. I hope you're clear with that, friends. Sajuddin Uluvar, your questions are all wasted. Please don't worry. I have shared my WhatsApp number also. You can always get back to me with all your doubts. All right, don't worry about that. Unfortunately, the chat box was not showing any response. I was myself confused why nobody is responding. Anyways, good. I have got the chat box now. Whatever is there, I will try clarifying the doubts as much as possible. Okay, some Rangesh Badri, you have asked me, will you give us some PDF? Yes, I will be giving you a workbook and I'll be giving you a handout. Being the first session, just excuse me. By today evening, you will all get the handbook, or tomorrow morning you can download it yourself and you can keep it with yourself. Okay. All right. The next doubt which is coming over here is, there is a guy who is from 10th standard is also attending my SFM class. Great, yeah. He will definitely become a CA. Don't worry about that. I think that's it. Majority of the doubts are clarified. If anything else is left out, friends, I'll again give you my WhatsApp number if you have missed out. Please just note down my WhatsApp number, 8893 495263. Sorry for the first day. This chat box messed up everything. I didn't know that chat box can hide the chats from me. Now there's another question from Ramani. Is holding period return equal to bond equivalent yield? No, holding period return is again not coming here. It's coming in portfolio management, which is, for example, I'm holding my shares or bonds for 5 years. Holding period return is a return for the whole period. That is somewhat similar to yield to maturity. But when we do bond valuation, we don't use the terminology holding period return. All right, friends, have you all understood till here? Now, friends, it's 9:30. I'll pack up my first session. I'll just show you. This is a question what we are going to crack at 11 o'clock. This one question is a beautiful question where we will check how to value a bond using zero coupon bond, treasury bill, normal bond and half yearly bond. So this one question you can mark it as ODBE. The moment you do this, all the 4 permutation combinations of bond valuation will be covered over here. All right. Then we'll do another one beautiful question which might take around 1 hour. This question covers another advanced concept of duration and volatility, which also I will be covering at 11 o'clock. And friends, so that whatever I have learned, I hope you have understood when I took the videos, but all of you might not be as fast in which I am doing this. Okay, one of the doubts is that will you cover all the chapters? Yes, I'll be covering all the chapters in the limited time. If something is left out, I will tell you how to take it forward. 5 days, 20 hours, you will get my 100% attention. I will try doing 110% of my thing, what I can do, but I will not go fast because I want to ensure that all of you understand the whole thing. All right. And friends, I'll just share with you one more thing over here. When you're free, just go to this website. This is my website, tarunjagdish.com. In this website, you have all the videos, concept videos free of cost. If you see on top, there is a button called as concept videos. You just have to click on this. You see here you are having costing and SFM. Right now we'll focus on SFM because that's what we are learning. So if I just click on strategic financial management, look, if you come down, you see all the logics that we have taken. The videos are all available over here. Basics, logic of NPV, cash flow discount factor. We learned this today. Logic of IRR also we learned. Logic of how to value an asset we learned over here. Perpetuity we haven't learned yet. We will learn it later, but the video is already available over here. Bond valuation, meaning we learned. Logic of yield, first 3 formulas also we learned. Logic of yield to maturity also we learned. All that you have to do is just come here and just click on this video. The moment you click on this, it will go to my YouTube channel or it will come here where you can just click on the video and the entire video will start playing, which is already pre-recorded earlier. So whatever we have learned, you can relearn it, and the concepts and the examples will be almost the same as how we have done in the class. All right, friends. So I hope you are clear with this part also. Okay, shall we pack up our first session? Brinda Sri, I'm sorry, we will not get time to cover the theory part. We will be doing only the practical part here. I will share a theory handout with you so that you can definitely learn the theory on your own. And Kevin George, you asked, will the videos be available anytime? This is a live session. It will be stored and the videos will be available at any point of time for you to view it so that you can revise it later on also. All right. Thank you so much, Gauri. I appreciate that you have liked the class. Thank you, Ruchi Jain, and thank you all of you. We will wind up this session now. 11 o'clock, we'll get back over here and we'll start cracking some advanced problems on bond valuation. Then we will go to dividend policy, only what is applicable to the new syllabus as well as old. And then tomorrow we'll do portfolio, then international finance, derivatives, mergers. We will go in this order. All right. Thank you so much, everyone. Have a lovely day ahead. See you back at 11 o'clock. Thank you so much. Thanks a lot.